Welcome to Chit Chat Stocks. This is another episode of our weekly Power Hour episode. It is earnings season, and we are officially kicking things off. We've got a couple companies that have a couple big names that have reported already, so we're excited to talk through those. Tesla, unfortunately, reports after we have this conversation, but there's been some other reports as well. So we're going to dig into those. We actually had a premature earnings report, which I always find a little fascinating. Feels like maybe they're trying to get out ahead of some bad news or bad reactions, which seems to have been the case. But we've got some other conversations as well. I've got an interesting look at a previous uh, non-small cap. My small cap of the week was at one point an $18 billion company. So we're going to talk about that. It is no longer an $18 billion company, but the story might not be over yet. So we're going to talk about that. Brett, what other topics do you have?
Yeah, I got a lot of listener questions, a lot of listener suggestions this week. Someone wanted to talk about Lyft. They said we covered them a while back and the price is the same, but the profits and financial statements have gotten better. So I thought, hey, we haven't looked at them in a while. So when we talk Uber with you, maybe we talk Lyft as well. We have some questions on Apple. We have some questions on the satellite providers, the satellite internet providers, and what that can mean for the various industries out there. And yeah, I think it's going to be a fun one. Hopefully, we get some listener comments, listener questions. Definitely not searching for topics as we head into the heart of earnings season this week. Although I should say, if you're listening to this on Sunday, we record these Wednesday morning. So any earnings that happen Wednesday morning, we've seen. Wednesday afternoon through Thursday, we have not.
All right, before we get to that, though, I want to talk about our friends at Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account at public.com. That's a pretty big deal because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments, but you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks. I got a spot that I want to start here. Big
Okay.
news, maybe. Big rumors, I should say. Uber to potentially buy Expedia. Did you see this headline?
I did see this headline. I wonder who leaked it. I'm guessing Expedia probably leaked it. But what are your thoughts? Should they? Shouldn't they? I was surprised using Expedia for a rental car. The app works pretty well. I liked it more than Booking, although I know that the financial performance hasn't been nearly as strong.
Yeah, it doesn't, I don't know, it doesn't really make a whole lot of sense to me from Uber's perspective. So, just for context for anyone who doesn't know Expedia very well, they own a number of different, uh, I guess you could call it travel related brands. So, lodging, flights, rental cars. So, things like VRBO, hotels.com, rentalcars.com, their actual namesake, Expedia. And I mean, it's really functions, I guess, similar. I would say it's probably closer to a Booking Holdings in terms of business model than an Uber. But there is some tie-in here, which is Dara Khosrowshahi. I hope I'm saying that right. Used to be, well, he's a non-executive member of Expedia's board still, and I believe either ran the company or it was while it was in IAC, he was had a very good understanding of the business. He's been involved with Expedia for a long time. My thing here is I don't really understand where the synergies are. So I just don't see a I know it's really popular in a lot of Asian countries and some other markets to have like a super app, something where you're doing multiple things at once, all within the same app. I don't really think that's I can't really think of like any instance where that's common in the States. And Will people really go to Uber to book their flights? I don't really think so. Will they go there to find hotels? Probably not. Um, if it's just an acquisition, they're going to keep the brand separate. They're going to run it more efficiently, something like that. Great, maybe that's worth it. But I don't really see any synergies here.
Yeah, I don't either. Maybe the price is good. Like you can buy them at a cheap earnings multiple. Sure, that could be the case. The one thing you could argue is that you could build a large loyalty program. You know, you get discounts if you're on Uber One or that membership thing they're trying to build. But besides that, yeah, it doesn't really make sense. It would make more sense for the things that Uber and Booking, or excuse me, Expedia and Booking have already done with the rental cars, with the flights, with all that. That makes sense. But the ride sharing aspect is not something you generally plan in advance. And maybe there's a rental car connection, but is that a reason to buy this company and build a super app? And that's not necessarily a super app either. I think these are two totally separate businesses, two totally separate use cases. One, yes, Expedia is trying to build the travel, say, quote unquote, super app where you can get the rental cars, the lodging, and the planes. But Uber, that's an entirely different thing. Yeah, it might be part of your travel itinerary, but it's not, you don't plan it in advance like everything else here.
No. No, what would you say is the order of things if you're traveling? It's probably
Destination
your
and lodging,
lodging first,
plane.
destination and lodging, flights, and then
If
Uber's
you
like as you're
maybe rental
there.
car. Yeah.
Yeah, I don't know. I don't really see I don't see how they could all kind of blend into one. Maybe there's like some financial reason for the acquisition that's aside from any sort of synergies here or any sort of strategic rationale. For context on the size, Expedia has a market cap of around $20 billion, whereas Uber has a market cap of almost 170 billion. I don't know what the acquisition would look like. This was not confirmed by either side, so we'll see if it
Definitely
really
Expedia
amounts to
linking it.
anything. Yeah,
Uber doesn't wanna be
probably.
that being leaked. We have a comment here that says Uber could buy a rental car company to provide car inventory for their drivers, increase their moat relative to Lyft. Yeah, and they're trying to, get into Turo's, space and have essentially copied that and put it into the Uber app. I'm curious to see how that competition between Turo and Uber now will progress, see who's gonna win. Speaking of Lyft, though, we got a comment. I don't know if you have anything on Uber, but this does relate. Let me get the comment from one of the listeners that said, "Hi, I did listen to an older episode on Lyft. There were some questions on profitability, but the stock price is the same, and it looks like the company has made great improvements and could be a buy from here." So I pulled up Lyft's financials, Ryan. I got first gross profit keeps growing higher. Last 12 months, so their last 12-month gross profit compared to September 2021 has grown at a 26% annual rate. Operating margin from, let's just do a year ago. So they have the June quarter. June of last year, on the last 12 months, operating margin was negative 25%. June of 2024, over the last 12 months, negative 4%. So still negative, but getting a lot better. And you can see that there's room for improvement here. I'm going to maybe pull up a valuation number quick on FinChat. PE, actually, we probably can't do that. Let's do price to gross profit, maybe. That might work the best. I know that's always a dangerous multiple to use, but since they're not profitable, I think that makes sense. Only 3.4. Market cap must be quite cheap. 5.7 billion dollar market cap, enterprise value $5.2 billion. You pulling up free cash flow there, Ryan? Yeah, look, cash flow positive. They're not going to have balance sheet concerns. I know that Lyft is a way worse brand and is the second player, and you never want to buy that. But hey, does this look cheap? What do you think?
I am assuming here, I'm looking at free cash flow and I'm looking at operating income. Free cash flow last quarter was $256 million, a huge step up actually from where they were a year ago. Operating income was negative $27 million. I am assuming, let me actually just pull the numbers up so that I can make sure I'm not just making baseless assumptions here.
Yeah,
Stock-based
stock-based
compensation.
compensation, you mean? Is that what you're trying to?
Yeah, it's a portion of it. It wasn't as high as I thought, so it's not making up the entire discrepancy there. So, I don't know, maybe it's worth digging in a little more, finding what we would consider their true earnings, what to kind of value the business on, and I won't omit it. I will say we're gonna talk about this with one of my small cap of the week. These companies where they aren't like I don't believe too much in the business. Um, I don't think they're positioned that well for the future, but maybe it's like a turnaround or you could juice some returns out of the next year or two. I've kind of strayed away from those over the last year since we shut down the fund. I've really done I've really skewed towards companies where I don't have to actively manage it or I don't have to fret every quarter, and I have lots of belief that the long term looks promising, and I would not throw Lyft in that group.
I agree. What's interesting though is you look at Lyft and you go, well, is a third player going to come in and steal them? Is take over? Probably not. And I don't know. I think it is interesting. Here's the other question I would have: are they an acquisition candidate? Should anyone buy them? Does it make sense for anyone to buy them? Instacart, DoorDash? I don't know.
Uh, I would say probably not. Maybe there's some sort of a blend there because Uber's consolidated it all into one app, but I think you're probably better off trying to build some of those features as because acquisitions are always spotty, especially with
Yeah.
large companies that you have to integrate two cultures. Usually it's two different like back ends, two different systems.
Well,
It's
if you're
a
Lyft
lot of
shareholders, it doesn't matter. I'm saying as a maybe downside protection for Lyft.
does Instacart or DoorDash have the capacity to do that?
Probably if you want to use that stock. Hey, I'm guessing DoorDash has. Let's look at that market cap. I'm guessing it's quite comfortable for buying Lyft. Yeah, $62 billion. So yeah, they got plenty of capacity. I
Maybe there's a world
think.
where they could do it. The Yeah, maybe this could be sort of the Lowe's to Uber's Home Depot, if you want to make that analogy.
Yeah, hey, anecdotally, people still go to Lyft to price compare. Not that much. I know Uber has a lot of market share. They've retained that market share. There is a path to them generating $500 million in free cash flow a year, some of that from SBC. But hey, you look at that market cap, they got that ex Amazon guy running it. I know that it's almost misleading, where it's like just because they worked at Amazon, it doesn't mean they're smart. But it seems like he's done a fantastic job so far, at least from getting them to break even. Yeah, call me semi interested as well.
All
All
right.
right. Want to talk
Mildly
about
optimistic.
sorry?
Mildly optimistic.
Yeah, yeah. Well, cautiously optimistic using our earnings call lingo. Do you want to talk? I know we have some comments here. Someone wants us to talk about Tesla. I told them at the end we'll give a earnings tease that'll probably be wrong. So we'll save that for the last minute there for anyone that cares about that. But it doesn't matter. The earnings are going to come out soon. We have someone that asked, "Hey guys, did Ryan finally jump on the HAPE train after the last drawdown?" I should say I'm interested in them as well. I don't think either of us have bought it, but the price is staring us in the face. They have a little drawdown. It seems like nicotine pouches are still growing. If we want to segue into the Philip Morris earnings after this,
Yeah, go ahead and save the suspense here. I have not joined the HAPE train.
but why
I don't
haven't
know
we? We
why.
should. I feel like we should.
I have this issue where, especially with small caps, and I'm looking at Kelly Partners Group right now as well, and it's kind of in the same boat here, where they become very popular on certain forums, Microcap Club,
Yellow Brick, our
FinTwit,
sponsor.
yeah, anywhere where there's been some write-ups and there's sort of a community of investors, certain micro caps, certain small caps become really popular. And part of that's because there probably aren't that many high quality companies where there's a huge reinvestment runway in that cohort of companies. So in like the small cap, micro cap basket. And whenever it gets that popular, I get wary. But I don't know if it really, like, affects the valuation. Just because it's a part of, like, a small community.
Yeah, and how
It
many
might,
people are
but
really on Twitter? I don't know. It's always hard to see,
and
like, is it just our bubble?
yeah, and the other part is if you think about a company like Hape or a company like Kelly Partners Group, this is the same thing that happened with Expel. Expel was very popular in microcap club, and a lot of people owned it. There were a lot of good write-ups. It was like literally a community effort to becoming shareholders in that company, and the returns were incredible even after it was extremely popular. So I think with companies where the upside is there and there's like a huge addressable market that they can go after and maybe an expanding addressable market, who cares if it feels crowded in the moment? So maybe I just got to shake that like bias I have and just if I like Ape, I like the valuation, I like the financials, and I like the opportunity, maybe I should nibble a little bit.
Yeah, hey, and, I should say that they are microcaps. They are, I think both international, but Hape is at least in Sweden, so hit us up with any question on that, on the best way to buy that, and definitely do your own research because we haven't fully researched either of those companies. Let's see, question here before we get to Philip Morris, which I wanna talk about because that's a nice, way to brag about, one stock that's worked for us this year at least. When buying microcaps, you always have to wonder who you are buying shares from. Who's the guy selling? Does the guy know about the same upside case as we do? It's a tough question to answer. Yeah, microcaps are different. It's not just liquidity flows from index funds. There are the flows from potential buyers do matter a lot, especially if it's not one that's going to be buying back a lot of stock. It's someone that's in growth mode. You have to kind of think about, all right, is this going to be stuck in the mud for 3 years? What's the catalyst? All that good stuff.
Something that was interesting with the Jason Hirschman interview, who owned Expel for a long time, and that kind of drove a lot of his returns, is he said when you have a microcap that is doing well, for some weird reason, even though it is completely irrelevant, people that have been shareholders for a while sell at round numbers. Like
Really.
just because like it's like once it hits $10, I've got my returns, I'm taking it home, whatever. So maybe there's times when it's people are just want to they've realized their returns. I don't know if that's quite happened with Hape and Kelly Partners Group yet, but I don't know. Maybe they're just cashing out. So maybe there's sellers like that as well. But yeah, it's a tighter group of shareholders, so you probably have to understand what sort of the bear case is on any microcaps that you're purchasing. Do we want to talk Philip Morris?
Yes, we do. And I would say for anyone that didn't connect the dots and didn't listen to that Microcap Club interview with Hirschman, the stock he talked about the most on that episode was Hape Group. So that's kind of why we're so interested in it because he was one of the people that found Expel, and that ended up being a hunter beggar. So whatever he was talking about next, hey, that could be something worth following. But yeah, let's talk Philip Morris. What do you got from
I
us?
did
Is the
want to,
nicotine resurgence back, Ryan?
yes, and I did want to also, I don't, you talking about Jason Hirschman and Xpel reminded me of this before we get to Philip Morris. David Gardner, Netflix jumped 10% last week. And I love that he does this. He reported his returns on his cost basis. And it was in that one day, I believe it was a 46 bagger on his cost
41, I
basis
think.
in a
Yeah.
day. 41. Is that the single best investment you've ever come across?
I think we're
Like single
getting
stock
there.
investment.
Yeah, I think we're getting there if Netflix over the next decade, I'm not gonna say it's gonna 10 bag, but if it gets a little bit higher, because I know he probably started it as a small position, so there's gotta be a lot bigger than, say, some of Buffett's investments, like in Geico, stuff like that. I think it's getting close though. And if he keeps
I
holding,
thi-
which he does, that's his strategy is never sell. They keep generating a ton of cash, buying back stock. There's plenty of runway for him to keep appreciating on this investment. Although I wouldn't be surprised if the stock goes through a drawdown. It's kind of it's fully priced at the moment. I think.
yeah, I was thinking about that. The Like maybe it was just a tiny position for him to start. But let's say it was just $1,000 position. It's become $500,000 almost for him. So
Yep.
it's pretty impressive, no doubt. And the day that he gets 100 bagger in a single day on his cost basis will be probably one of the most impressive investing feats I've ever witnessed. But
Yeah, maybe that's when I'll call it the best investment ever because again, it's not about the costs sorry, the position sizing at the start is not the most important thing. The most important thing for that strategy is the holding because he has to decide to hold it every day and no one else really has.
through a yeah, that's been through some major drawdowns for Netflix as well. But let's talk Philip Morris earnings. I'll go through some of the numbers here quickly. Total shipment volume. So that just includes the cigarettes business, the oral nicotine, so predominantly Zyn, and the smoke-free, or sorry, the heated tobacco, which is
Yep.
pr- primarily IQOS. You combine all those, total shipment volume was up 3%. So this is officially a growing business again in terms of volume. Probably one of the only tobacco companies with growing volumes over the
Yeah,
last
well,
2 years, 3 years.
we had a question on Twitter that said, "Are they officially not a tobacco company anymore, and are they a nicotine company?" I think possibly, but they're still under 50% uh, new age nicotine products. So maybe when they get over 50%, we'll officially call them that. But I have here for the chart for anyone interested. This is excluding oral pouches. So this is cigarettes and then the heated tobacco shipment products, which the HTU product is much bigger than Zyn and nicotine pouches and vaping at the moment. Since December 2020, this has grown, and it looks like every single year. So it's officially a trend, and I don't think it's a blip. And we can see that IQOS and now increasingly the nicotine pouches are not just mitigating the volume declines in cigarettes, but making up for it and some, which is a huge change. And this is why the multiple has started to expand.
Do you know what I forgot to check, but do you know what the portion of revenue that comes from the oral nicotine segment is?
Oh, I haven't calculated that, but I think for the stuff for the non-cigarettes, I think it hit 40%. That was either volumes or revenues, but I can check on the press release right now. It was right at the beginning of the press release.
I mean, like, strip out the IQOS, just the Zyn, basically, business.
Ooh,
Probably somewhere in the 10 to 20?
it might be less. It might be less, but it's growing so quickly, so
Bummer.
that's why people are excited. I think yeah, it doesn't matter. IQOS is more important because that's a $10 billion business, and nicotine pouches are nowhere near there.
One day. One day.
One
This
day,
does
and,
remind me what just absolute atrocity it was that Swedish Match decided to sell their souls to big tobacco, but that's okay. We don't dwell on the past here. Revenues were up 8.5%. So remember, volumes in total up three, revenues up 8.5. So let's just volume plus pricing growth. Gross profits were up 9.5%. So gross margins and operating margins were both expanding as well. Adjusted EPS was up 14%. So, and that was all the reported numbers. They do have a bit of a currency headwind. I will say, uh, if more and more of the revenues start to come from the US, which as Zyn grows or outpaces the rest of the business, that currency headwind should start to abate a little bit.
yeah,
It'll
a
take
little bit.
quite a long
That's
time.
it's gonna have to grow a lot to
If
really
ICOS,
impact it.
yeah, I mean, if the ICOS launch in the US is successful, just the
Yep.
US revenue as a percentage of the pie, since they have to convert their euros or wherever back to the US. Hopefully that abates a little bit, but basically strong numbers across the board. The cigarette portfolio is holding steady. Volumes were actually up a little bit year over year for cigarettes across the board. ICOS continues to grow, and Zyn has been just an absolute growth machine. And they're actually investing a lot into new production plants for Zyn in the US. That's a big part of their capital expenditures.
And internationally. And it seems like they've caught some fire in some new markets as well, so hopefully nicotine pouches grows outside the US.
Nice. I did not catch that. It's basically the reduced risk products continues to grow. Cigarettes is growing modestly on the top line. It's about flat in terms of volumes. And they upgraded their guidance. My question here is so Philip, maybe you can fact check me on this, but Philip Morris's stock's probably up about 40% year to date, would be my guess. Somewhere around there. I
Yeah, I
know it's
can
trading
check
at like
for you.
$90 when we bought. But
Yeah,
what from
37%.
this okay, what from this report was not obvious like 6 to 9 months ago? It's all the
And
same. Like IQOS was growing modestly, like pretty much double digit percentage revenue growth. The oral nicotine looked very promising. They had the two category leaders, and cigarettes was steady.
maybe
What has
combustibles.
changed?
Maybe combustibles, people were predicting volume declines. I'm not exactly sure. Maybe people were not excited about, I don't know, they thought growth was going to stall in new age products. Margins were coming down, and you had to kind of take management's word that the unit economics were good or not, getting worse because margins have started to come down a bit. And they've recovered this quarter, I believe, but they're still very far from what they should be. And someone could argue that these new products are structurally less profitable, but I think it makes a lot more sense to think, okay, they're reinvesting a ton for growth right now, and then once it matures, the margin should recover because there's no reason that you can't sell these same products at similar profit margins, at least I would think, to cigarettes. For your note or a note on your previous question, here's what they said on the press release. Quote, the smoke-free business accounted for 38% of our total revenues and 40% of gross profit. And look at that. Gross profit's even better from the smoke-free business. So I would argue margins could even get higher, but maybe not. Doesn't really matter too much. Either way, yeah, there were some, I think, basic arguments you can make earlier this year, but the one thing people look at is they group it in with the other tobacco companies, and they say it's already trading at a premium price, and then they probably looked at those what kind of basic things: foreign currency headwinds, combustible volumes going to go down, uncertainty around the growth of ICOs and margins. I think you kind of look at those and bat them away if you did some simple research with the company, but that's probably what people looked at. And maybe some of that's priced in today, but I think there's no reason to sell anytime
No,
soon.
I agree. What I understand if if you didn't buy Philip Morris like 6 to 9 months ago because you're just not familiar analyzing the tobacco companies, or you just didn't really look at it, or maybe you just kind of thought it was like predominantly a legacy cigarettes business that'll be no growth. Like I get it, totally understand it. Where I do fault people is the ones were that knew how to analyze tobacco investments. They knew the company, studied it well, and they were like, "Well, it's not as cheap as the other tobacco companies." It's like it, you should just look at it across the world of equities overall, not base it versus British American Tobacco. And also, I just it did seem like a lot of people that owned Altria and British American Tobacco and some of the other ones, like chase the dividend yield and were just I don't know, like unwilling to accept that there was such that Philip Morris was the category leader for reduced risk products.
Yeah, the way I looked at it is Philip Morris International traded at, maybe was it 15 times earnings, maybe a little higher. And my thinking was revenue can grow at 10% for probably the next 5 years due to pricing power from combustibles and maybe 20%, 15% volume growth on these new age products. Then you also have margin expansion that will happen as these new age products scale. Add in the dividend. I think even if you didn't get any multiple expansion, you get solid returns. And we're seeing that, I guess, luckily materialize within a year. But I would have thought, yeah, like 15% returns made sense from there. And we're on that path. Now we have to keep track of that every quarter because they could diverge from that path and it's not guaranteed to keep working, but so far so good. We have a question here though, and it kind of relates to Philip Morris. Do you have a preferred method to separate growth CapEx from maintenance CapEx? Not really. You got to kind of trust management. I don't have a big team of researchers that can go try to figure this out, but one thing you can look at is historical cash flow numbers. One thing you can also look at is just it's almost like how it leads to revenue growth or volumes or stuff like that. I don't know. It's tough. It's tough because you have to trust management from our perspective because we're individuals.
Yeah, it. You just got to hope that management's pretty forthright about it and says it throughout their calls, basically.
Yeah, and like with restaurants, they can tell you the number and they can tell you the cash on cash returns, but eventually it's got to show up in consolidated free cash flow. And I think the best way to do it, which is tough when a business is growing, the best way though is to say, okay, do the unit economics make sense? Do I have historical examples of similar businesses? If they do, then I'm comfortable in this growth CapEx having good returns on invested capital.
All right. Do we want to talk about the McDonald's E. coli outbreak? You see
Sure,
this
we had
headline?
someone ask about that. I said I didn't know much about it, but do you got anything?
I read uh, just a brief description of it this morning. Basically, 10 people have been like reported with E. coli, apparently from eating quarter pounders. One person died, and it was McDonald's basically said it was potentially from their onions. They have
Uh-oh.
removed the quarter pounder from certain menus in certain states. And McDonald's stock dropped 4% this morning on the news. Is this a potential Chipotle 2.0 situation?
Mm, probably not. I don't know. Surprised. I thought none of this was real food. Did they? If it's so processed, you can't have this going on. I understand Chipotle with their real food brand is trying to, could run into this issue, but I thought this was all frozen stuff where this is mitigated. I don't know. Okay, but seriously, yeah, you don't want anyone dying from these products. That's sad. Um, who knows? I just don't like McDonald's. It's too mature. It's almost like a bond. It's not for me. Maybe it's for someone that's 50, 60 years old, but I don't know how big this business can get.
It's
Like
also surprisingly expensive.
exactly. Yeah.
Do we want to go through our small cap of the week?
Sure, yeah, let's do it. We are about halfway through the episode, so if you want to hit any sponsors as well, feel free. Should say we were using that chart. Maybe I'll just talk about FinChat before we get into this. We were using that chart from FinChat.io on the volumes for Philip Morris. That's one of the charts I look at every single quarter. And instead of having to do it myself, they do it for me, saves me time, and I can visualize the data that is important for me to track. You can check that out at finchat.io/chitchat. Get a 15% off any paid plan. Use the link in the show notes, and they have a free product as well. So just use the link, try it out. I don't think anyone that listens to this show will regret it. But yes, Ryan, why don't you go through our small cap of the week? A interesting company to say the least that we covered. Didn't we cover this during the bubble in 2021 and almost had an episode where we were just laughing the entire time?
Yeah. Yeah, there was one point where like the headline valuation numbers looked almost attractive, but yeah, the business was pretty horrendous. I will say just before we get into this, yes, FinChat, we use them all the time, and it's incredible during earnings season with the KPIs. So Zin volumes. I'm going to talk about Starbucks here in a second too, comp sales, stuff like that. It's wonderful. So at least check it out. But before we get to it, I do want to mention our sponsor again, Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You may want to act fast because your yield is not locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/Chit Chat Stocks. Let's do small cap of the week. So I wonder do you think listeners have any idea what company we're talking about?
I'm going to share the chart right now. It's not going to give it away, but let's look at this 5-year
Oh,
stock
boy.
chart, which I think just goes back to 2021. Ticker is LOGC. I don't know if that gives it away. Ryan, do you want to go through what this company is?
Sure, and I apologize if anyone can hear some background noise. We do have someone's mowing a lawn near me, but I think it's fine. So small cap of the week presented by Yellow Brick Investing is ContextLogic. You may remember them as Wish. They were at one point the e-commerce company that was going to disrupt Amazon. This is
Timu's
where you could
Timu.
buy yeah, it was Temu before Temu. You could buy like quote unquote Beats headphones for like $6. So basically it was just all knockoff goods. And in 2021, I mentioned this earlier, they had a market cap of $18 billion. It's rumored that they turned down a $10 billion acquisition from Amazon, which bit of a red flag on Amazon's
I
part, if
doubt.
that's true.
Yeah.
I hope not. Because why would
Hey,
Amazon even need it?
we're just psychologically long Amazon as kind of our Mag 7 pick. So I don't think, or no, you own it. You own some shares. I don't. I'm
Got like 2
psychologically long.
shares.
Yeah.
I got
Starter
tracker
position for
position.
Ryan.
Well, anyway, today I mentioned it had a market cap of $18 billion. Today it has a market cap of $165 million. So down a whopping 99% from highs. However, the story might not be over yet. So shout out to one of our listeners for recommending this. By the way, if you have any small caps that you want us to look at, feel free to shoot them into the YouTube comments or email us at, what's our email? chitchatmoneypodcast@gmail.com. You can find us on Twitter, wherever. We will hopefully check it out. But yeah, so the e-commerce business is admittedly a disaster. It seems like everyone knows this now, and I don't even know if it's truly operating anymore. It just basically hemorrhaged money. And if you look at maybe you can pull it up on FinChat, the cash and equivalents chart, it is just
I will.
like a direct staircase down as they just hemorrhaged cash.
Yeah.
But it appears management and analysts and the investment community at large figured that this business sucked a while ago. Do the quarterly, Brett.
Quarterly.
It's
All right.
wonderful. Brett's pulling up a chart here for anyone listening.
Listeners. It goes back to, it was even higher before that, but September 2021, 1.2 billion, 150 million over the last June 2024, and it just, I mean, they burn cash. This has to be what Temu's looks like, except they're funded by a giant profitable company from China.
Yeah, that's owned by Pinduoduo, isn't it?
Yeah.
Okay. Anyway, yeah, they lost a lot of money. They were a really bad business. But here's a timeline of what has happened since. On November 7th, 2023, so a little under a year ago, ContextLogic, formerly known as Wish, announced that it had initiated a process to explore strategic alternatives for Wish to maximize shareholder value. And they retained JP Morgan to assist in the process. Congrats, JP Morgan, for always just finding a way to broker these
Get
deals.
some fees.
They contacted 40 potential partners and evaluated a variety of potential outcomes and transaction structures. On February 12th, 2024, so 4 months after they started the process, ContextLogic announced that it had agreed to sell substantially all of its operating assets, including cash on the balance sheet and liabilities, and its Wish commerce platform to QOO10. It's an e-commerce platform that owns a couple marketplaces in Asia. I believe the company is based in Singapore for $173 million in cash. So I might be losing some people, but basically here they were looking for a strategic buyer, someone who could come in and hopefully either take the bag of crap from them that they had created or just shut it down. And one of the board members of ContextLogic said the board believes the transaction will effectively reduce the cash burn to zero and monetize its operating assets. Here's another snippet from the article I read. Following the transaction closing, ContextLogic will be publicly traded. They believe the transaction will reduce cash burn to zero. Balance sheet will be debt-free with the $173 million in net cash proceeds. And here's kind of the catch. $2.7 billion in U.S. federal net operating loss carry forwards and some
That's a
other
lot.
retained. It's a ton. They lost a ton of money.
Wow. They were good at losing money.
And more than $8 billion of state net operating loss carry forward. So, and this has all happened. The transaction has closed. It's over. Cash burn has dropped substantially. And they've got these huge assets. But here's where it gets kind of interesting. As I understand it, they've basically gotten rid of the operating business. Now it is basically a shell company of some cash and a ton of tax assets. But, and I could be getting some of this wrong because I rarely invest in bankrupt companies. In order to use your tax assets, you have to have taxable income in order to offset. So you have to have like a profitable operation, or else it's just kind of this value. It's a valuable asset, but it can only be truly used to offset taxable income. So here's more on the story. It says the acquirer is targeting profitable operations for the continuing business. I have no idea what that looks like. I don't know if that means they're trying to revive Wish in some capacity, or they're going to acquire some sort of other profitable operation. I really don't know. But management has said if they are not able to identify any opportunities to use in order basically to monetize their tax assets, they will just return all the capital to shareholders. So the stock is $6.30 per share currently. They would return basically $6.50 in cash. So feels like there is a bit of a high floor here. And there is, let's say they found some sort of a profitable operation, they've got essentially 10 billion. No, sorry. Some value, some substantial value relative to the size of the company in tax assets, which could make the stock worth significantly more. My opinion, after looking at all of this, is that it's too complicated. This is not really the kind of thing I invest in anymore, nor did I ever really have any success investing in it in the past. And it's like, I think there's still the risk that they try to revive or create some operating business that still drains the cash that's on hand. So even though they said they would return the cash currently, this might just be basically liquidation value for the tax assets.
Yeah,
It
that is a
seems
big risk.
risky.
Yeah.
Well, I guess not
Are
really.
they trying to get
It seems
acquired or
boring.
acquire a profitable business?
I don't know.
I would
They've
just
been
want to get
vague.
acquired. Like, just take me these tax assets off for $1 billion, right? Something like that, to a company that could easily use them, like a large company.
I don't know if that, like,
Maybe it
if
doesn't.
there's
Maybe
any
that's not how the law works. But
yeah, that's what I'm confused about. I don't know if a company can just do that. But it seems to me like this would be incredibly boring to own. It's probably going to trade at basically $6.30 or around 6.50 for a while, until there's some sort of an
$6.24
establishment.
today. Discount, Ryan. Big discount.
Yeah, I guess. I don't know. It
No,
bores
you're
me,
right. It
but
has
it's an
traded at the
interesting
same
case
price.
study.
Yeah.
Okay. Because we'll see what comes of it, but it's fascinating to see what happens to the darlings of yesteryear when they are down 99%, and this is what it looks like. You have some assets. The CEO/founder probably made a boatload of money on the IPO, sold a bunch of stock. He has had a great time, and the Wish shareholders are hoping for something to be left, some sort of salvage value.
Yeah, it would be interesting if you're an activist investor. It would also be interesting if you're well versed in the law stuff that would apply here. So if you have that going for you, that's great. And then it's trading at a 1x book value and has these tax assets. So if you know what to do with that, hey, let's get a deal going. But for us, can we catalyze that ourselves? No. Would be fun to follow, though. I
Yeah.
think we should check on them, and I'll be very interested to see what actually happens.
Yeah, this is the kind of thing where maybe when we were running the fund, I would have dug in a little more, seen if there was like something here that I could understand and get some sort of uh I'm sure a lot of people just omit it. Like they just hear that it was Wish, they just discard it. But
True.
maybe there's some sort of a edge here. But I just have no interest in owning these kinds of assets anymore, these kind of companies, since I don't really check it that regularly and don't really
Uh,
have the capacity to get super into the weeds, which you would need to on a company like this. But yeah, changing topics here. I want to start doing this again. We used to do this a long time ago. It doesn't need to be like every week, but whenever we come up with one, the anecdotal evidence.
all
I thought
right.
this was
Well,
fun.
hey, before, I think you're forgetting, do you want to talk about our small cap of the week sponsor, Yellow Brick Investing?
Oh, yes, of course. Just so everyone knows, whenever someone pitches us a small cap of the week, the first thing I do is type either the name or the ticker into joinyellowbrick.com, and you instantly find, I would say, pretty much every stock I've looked up, I have found a write up, a stock pitch of some sort from somewhere across the internet. It's blogs, hedge fund letters, analyst reports, podcasts, even. They span the internet and bring it to you all in one place for great stock pitches. So, highly recommend checking it out. It's joinyellowbrick.com. If you use joinyellowbrick.com/chit chat, you can get a discount on any paid plans. And that allows you to see historical investor returns. So you can see who wrote it up and how they've done in the past. So,
Yep. And if anything, just sign up for that newsletter. Just get started. It's
yeah,
free.
it's literally just
There will be plenty of
stock
value
pitches
for
every
you.
day.
Yep. Exactly.
Yeah, I
Exactly.
still read it every day. Anyway, okay. I know I've been talking a lot here, but I'm curious what you'll think of this. So, I met with an Amazon engineer the other day. This is my anecdotal evidence for the week.
Your guy on the inside,
And
your sources.
yeah, I know it's out of the a million employees, I've got one source. But I I asked him what he thought of the new 5-day rule, and he wasn't a huge fan of it. And he said pretty much nobody is. It seems to be upsetting a lot of people. It's forced a lot of people to uh, quit just because they can't support whatever it is an hour and a half both ways to kind of commute. Um, they also apparently are not giving many exemptions. So in this case, I heard that there's kind of a whatever sad story. They wouldn't give an exemption to it. There was a person that couldn't relocate, and they forced him to go in person. So they had to basically resign. The other thing that's happening is people are saying, "Look, I'm not going to resign. You can fire me. I'm not going to resign. I'm not going to work. You can fire me if you want." Because they know they will get their
That's
severance.
yeah, that's a good way to put it back, like, to kind of fight back a little bit. Is I know what you're doing here. I'm gonna take advantage of it as much as possible. Yeah, I respect that's smart. That's smart.
And so and there's a lot of other things that I found funny. For example, the 5 days in the week is uh, not actually that conducive for productivity, I've heard from a lot of people. So, for example, apparently now in certain places, you have to literally wait in line to go to the bathroom because there's so many people in the office.
Oh,
Um,
what a shame.
which
What a
I mean,
shame.
it's just yeah, but it is one of those things where it's like, is this really like, am I that much more productive for the company if I'm waiting in line for the bathroom, talking to people, slowing me down throughout the day kind of thing? I don't know. Everyone has their own opinions on it, whatever. But the one thing I took away was that people are extremely resentful with Amazon, a lot of the employees at the company, because it seems like kind of like we're not going to leave because we like to pay, but I hate the company and you can fire me if you want. Just super low employee morale. My question to you, do you think investors should actually care at all? And my follow-up question is, do you think this is just an inevitability as companies get larger?
Yeah, and your second one, well, I'll save that one because it kind of relates to my first answer here. Is perhaps my biggest concern with Amazon, besides the wasteful spending, is compared to other Mag 7 companies, which maybe just say Alphabet, Meta Platforms, Apple. These are employees they're competing for, especially for the software engineers, especially the ones that want to work at these big companies and not a startup. The employee quality is probably a concern, just anecdotally, of what you hear people talk about. But on the other hand, we have a source, someone that works at Google, or actually no, we have a we have a friend who has a roommate that works at Google, and they said half of the employees are way underqualified and don't know what they're doing. So maybe you're right. Maybe it's inevitability as companies get large, and maybe all these Mag 7 companies just have wide moats, have some really strong employees, but there's a lot of freeloaders. I think
Yeah,
though,
how many
Amazon might
freeloaders
be
does
going too
Google
far with
search
this.
enable?
What? Sorry.
Yeah. I said, how many freeloaders does Google search enable? That
Exactly.
business alone, you could build tons of operations that generate nothing in revenue. Is what you can do. And you can still have wonderful consolidated margins.
Yep. Exactly. Exactly. And for Amazon, they again, yeah, what I was saying is they may be going too far, and it, over like a decade period, it could ruin the culture, and that you don't want that. That could really hurt the business. You need people that actually care. You need employee morale to be somewhat high, and you can't be just alienating everyone. But for the next few years, it's not going to matter because it's not going to deteriorate the business overnight. If it
Yeah,
gets
Tyler
Alexa
here
shut down,
says,
maybe the stock, the profits will go up. I mean, come on.
yeah.
Like, "Oh, no, we don't have
It,
enough people to work in Alexa anymore. Oh, sorry. Gonna have to shut that one down."
yeah, Tyler says, fired for cause is a great way to reduce the net present value of your future income stream.
Yeah, it is
It's
true. Yeah,
true,
it's not good for the resume.
but I don't know. Like, would you rather just voluntarily, like, if your options are fired for cause or voluntarily quit and not get your severance, I don't know what I'd rather take, especially
Depends
if
how
you've been
large
there for
that
a
severance
while.
is.
Yeah. Anyway, okay, let's move on here.
I got
Any other
wait, we got
topics from
some.
you? Yeah.
Yeah, so I asked for comments on Twitter. I got 5 from our friend from the UK, in firm returns. I'll let you pick. We already hit one of these, but let you pick them. First, Boeing made a $6 billion loss in Q3. 2, Coca-Cola, volume declines. 3, rumors that Apple is scrapping production of the Vision Pro. 4, McDonald's shares hit by E. coli outbreak. 5, and I haven't heard of this one, Elon Musk has declared war on the UK government. That's something I'll be reading into later today. I do not know that is happening.
I'll be the first one, or I'm probably not the first one, but I will say I don't read many Musk headlines anymore. Like, I just
A lot of
don't
nonsense.
care. Yeah, I mean, he has issues with everyone. Everyone has issues with him. I just do not care. Okay, Boeing though. This I don't know if it surprised me, but I'm gonna pull up the chart here. BA is the ticker. Boeing
They might
Company.
have some net loss carry forwards. Hey, maybe they merge with Wish. Let's get a
Yeah,
little Wish
that's a
merger going.
merger
What's a
made
higher
in
quality
hell.
business? What owns a better business?
Uh, I'm tempted to say Wish here. Okay, so commercial division operating income. It's the KPI I'm looking at here. Quarterly. Let me share my screen. Of the last 22 quarters, Boeing has been unprofitable in its commercial services division or commercial planes division, 21 of them.
Wow. So that's strictly production, not the aftermarket.
Yeah, and it's strictly, well,
Like the building and the selling of the planes, not those
yeah, it's not the
profitable
services.
aftermarket services. Or is it it doesn't include
Yeah,
that, right?
it doesn't include services or their government division,
Defense and
but
aerospace government stuff. Yeah. Yeah, not
yeah,
good.
and
Not good.
I don't see this necessarily coming to an end anytime soon. The other thing, it it sounds like they may have gotten to a resolution with the machinists union.
Yeah, vote
How does
later
that
today.
affect their unit economics? I'd be I mean, it's probably gonna hurt them because it's, I think, rumored 35% wage increase.
Yeah, over
We'll
4
see.
years. I mean, that's sorta doable, but it depends what the other benefits are there. The thing is you can't, like it's the union, you can't the workforce can't come down while you do this and say so that's the issue. What's
Yeah.
also interesting is I think the backlog might work against them. You know how they have that 10-year backlog and they've signed all these long-term contracts? Well, they can't
Uh-huh.
I wonder if they can go to these airlines and say, "Hey, do you want to buy these for 30% more per unit?" Because no airline's gonna agree to that at once. Maybe they all would. I don't know. Does the government come in and say, "Hey, look, airlines, you gotta revise these to higher prices." It's just how it's gonna go.
Yeah. Which, one way or another, you will probably be paying more for your seats on airplanes.
Oh, yeah, and I mean, the flight attendant stuff and the pilot unions, they've had the same thing, 40%, basically the same thing, 40% pay bumps over 4 years. So, hey, ticket prices are going up by 50% over the next 4 to 5 years. Oh, unless somehow oil goes to 0. Maybe that'll help them. But yeah, all else equal,
So,
prices are going up 50%.
yeah, spend your miles now. Is that maybe the way to go?
Yeah, true. Maybe spend your miles now.
Because those will be devalued. Yeah, Boeing, man, they are in rough shape. It's it is impressive to me that they're able. For one, I am blown away at the valuation today. Um, it must just maybe it's just the ownership is just like all index funds and pension plans or whatever. But it's there's a very non-zero risk of them having to default on their debt. Or there was, I would say, and it probably still is, or at least some of it, or at least refinance it at significantly higher rates. I don't see how they're going to be earning money anytime soon. Keep in mind, the machinist union strike, they were losing money before that. They were
Yeah.
having a hard
Mhm.
time ramping up to like full capacity before that. So I don't know if they're just in the clear now. But we shall see, I guess. I still have zero interest in becoming a shareholder here.
Yeah,
I
I mean,
don't
they're
see,
gonna have
I
to
really don't see the upside.
yeah, there's no upside. It's crazy. Someone
It's
compared it
priced
to
in.
G yeah, so someone compared it to GE in, like, 2015, and I like that analogy a lot, where you might see a couple years down the line, the stock gets obliterated. They split up, the divisions into, spin out the defense unit, and, if one of them is well run, maybe it does well from there, but you're gonna have to see a lot more pain, I think, before any sort of resolution.
Yeah.
It's almost like it's
Starbucks.
you wanna
Oh, I
talk
wanted to,
Starbucks?
just because we're running out of time.
Alright.
Did you see any of the headlines?
I saw this morning that they pre-released. I wonder whether that was on purpose or not. I saw the new tagline from the new CEO. Well, the new CEO and his team that said "Back to Starbucks," which I kind of like. So they're saying we're done with this nonsense efficiency things, and I do like. Been watching a lot of football. They got these commercials that are kind of Chipotle-esque, where they just kind of show the coffee getting made, and hey, it makes you want some coffee. Not gonna lie. So that's my
Yeah, I mean,
analysis on the earnings.
it's sorry, I was on mute there, but look, maybe Brian Nichols able to turn this thing around, but the numbers are rough. Comp store sales declined 7% overall. North American traffic, so just transaction volumes declined. Let me make sure I'm getting this right. 10%. What blows my mind through all of this? Average ticket is up 4%.
Yeah. And when he
What
came
in
mid-quarter, right? So this is all the previous guy.
Yeah. Eh, yeah, it's all Howard Schultz, who he probably blamed Laxman Norrisman on.
Yeah. Don't
Uh,
don't bring in a consultant to run a restaurant. That's all I'm saying. Do not do that.
Here's the other thing. Yeah. I went back to the investor day from 2 years ago and
Oh
the
boy.
projections, especially for the China business. First of all, remember Howard Schultz says he thinks the business in China could one day be larger than their business in the US.
Maybe looking.
They estimated by 2025 4 to 6% comp store sales at their China stores. Do you know what their Chinese same store sales were this quarter?
-10.
Negative 14, driven by
Oh,
an 8% decline in average ticket and a 6% decline in comp transactions. And they
that's a lot of
said
macro though.
weighed down by intensified competition.
Yeah, but China's also going through a deflationary bust.
Sure. They
That's
said
part of it,
macro
but
environment, consumer spending. Yeah. But okay, when a company is willing to mention that competition is an issue and you're reporting 14% negative comps, it's concern, especially given how much investment they put in there. The other thing that is probably the most concerning out of all of this is they talked about all this stuff about getting back to the Starbucks core, um, creating. I think they talked a lot about like communicating better with their customers and like getting back to what they once were.
back to Starbucks. That's the tagline. Yeah.
I think the reality is they don't know why they're struggling. It's not like
Good
one
point.
thing happened. Like with Bud Light, you knew why comps were down. Like it's very clear, and now you got to find a way to fix it. With Starbucks, I don't think there's a clear-cut reason. Is it
Yeah,
the
yeah, yeah.
mobile order? Is mobile ordering commoditizing it? Is it, hey, this kind of goes with my anti-tipping agenda, but did it have to do with the when they instituted optional tipping? I
Yeah.
would be interested to see what has happened to traffic since then.
Yeah,
And
I'm sure Nickel's gonna get rid of that because it's not like for a chain, it's just not good customer service to be doing that. This isn't a local coffee shop that you're giving to the owner the tip and to the employees working extremely hard. Like they're the ones that make boatloads of cash and are supposed to pay their employees well.
yeah. Anyway, Starbucks. I don't know what it's going to take for them to get traffic moving in the right direction again, but if there's anyone that can do it, potentially it's Brian Nickel.
Yeah, I mean, he came up with Live Más at Taco Bell and the Doritos Locos Taco. So if that sort of innovation comes to Starbucks, maybe they could fix that. They need a Doritos Locos Taco. But you said 2022 projections. Now, I wrote an article this week that was looking at Lucid Group. Their 2021 revenue projection for 2024, back when they had their SPAC, was $10 billion in revenue. Can you guess how much they've generated over the last 12 months?
Oh man, those SPAC projections got to be fun to go look at. Let's go last 12 months. How about 3 billion?
668 million. And they're burning $2.6 billion in free cash flow. So yeah. All right.
What's the market cap?
Oh, it's like 6 billion. It's still extremely overvalued. Trades at a
Hey,
higher sales ratio than Tesla. Speaking of which, though, we
it's
say we give a
just a
tease.
supply problem.
Yeah, yeah, exactly. And they can't grow production for Lucid, but Tesla earnings, they're coming out after the bell. We're recording before them. We had some people asking for our predictions. Do you have any thoughts? I'll give mine first. The earnings, it's kind of been forecasted given the selling prices. It's not going to be a good one again, but my prediction is no one's going to care again.
Yeah, my prediction is that the numbers look rough. Automotive gross profits are down sequentially again, or down year over year, I should say. And and all they do is talk about the cyber car on the conference call. They talk
So,
about
the
the
cyber
the
cab, the
robot,
cyber
cyber
we
cab.
robot. Yeah, Optimus bot, we
Yeah.
robot event. Yeah. Yep. All right, that's gonna do it for this episode. We had someone that said, "Did you guys talk PM earnings, Philip Morris?" We did. About 10 minutes in to 20 minutes in, we did. So, yes, for anyone that's listening, we do these live Wednesdays, 1:30 p.m. Eastern time, 10:30 a.m. Pacific time on the Chit Chat Stocks podcast YouTube page. But we don't care how you listen. You can watch live for the few people that join along with us. If you want to ask questions, you can watch the replays on YouTube, or you can listen to the replays on Spotify, Apple Podcasts, or your podcast player of choice. Make sure to give us a review, hopefully 5 stars, to help grow the show. We want more people listening because then we can make our production even better and spend more time on the podcast. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast. They've held them in the past and may buy, sell, or hold them in the future. Thank you, everyone, once again, and we'll talk to everyone next week.